Hey, good morning. Okay, so Jerome Powell gave his testimony to Congress on Wednesday. Now, what's incredible is that Congress praised him for bringing in full employment, okay, and getting employment up there. Jerome Powell and the Fed did not bring in full employment. Full employment was brought in as a result of the pandemic. If you recall, back in 2020, when tens of thousands, hundreds of thousands, millions of people were dying. They left. There was a shortage of labor once the lockdown was released. It was the pandemic that produced full employment, not Jerome Powell and not the Fed and not the UK government and not the European governments. It was the pandemic. As a result of the massive loss of life, as a result of change of vocations, as a result of disabilities, as a result of people working from home, as a result of people changing their lifestyles, that caused a massive shortage in the labour market, not Jerome Powell and their tactics. What they didn't ask the question of, which was interesting, how Jerome Powell, the Fed, the UK, and the Europeans and other countries produced massive inflation through to their flooding the market with cheap money or loose money and cheap rates. That's what caused inflation. Not Putin, not the Ukraine war, not all other types of excuses. Was Jerome Powell and Janet Yellen and the Fed and Andrew Bailey of the UK and the UK government and the Europeans all created inflation. So they should not be commended on full employment. Full employment is a result of the death of millions of people. That's why we've got full employment, because there's not enough staff around, enough labor around to fulfill the demands in present industry. Now, full employment, moving on to economics, full employment is produced wage inflation. We have two inflations. We've got wage inflation, you've got retail price inflation or consumer inflation. Obviously, you've got other types of inflation, which could be like property price inflation, etc., which we're experiencing at the moment with a little bit of a downturn, to tell the truth. Now, so going to wage inflation is sky high. It's sky high in the UK, it's sky high in America, it's sky high in Europe due to shortage of labor created by the pandemic and further created by the attitude and the ineptitude of the central banks. So they should not be praised. Now, in the UK, they raised rates yesterday by 50 basis points. This is going to cause a property crisis. Now, I don't want to be melodramatic, but I did say yesterday that's going to cause a property crash. When someone commented, one of the viewers said that, it's probably going to be a correction. Let's be conservative. Let's call it a correction. Well, at the moment, you can negotiate properties, whether in the UK or the US, by 5% to 10% off the asking price. Let's call that a mild correction. Okay, let's talk about a major correction. Major correction is 25% drop in property, and there will be a 25% drop in property. Mortgages are becoming simply too expensive. They're now tripling. Those people where their mortgage fixed rate is now finishing, they're coming on to new rates, they're going to be experiencing a 300 to 400% increase in their monthly payments. Let's get that absolutely clear. 300 to 400% in their monthly payments. A regular household who's been more or less on a fixed salary with a slight increase of 3 or 4 or 5% on their wages now cannot afford a 300 to 400% increase in their monthly payments. That is going to force the mortgage or homeowners to downsize or sell their properties and move back in with their families, parents, or relations or friends, whoever's going to take them in. That will then force property prices down. So property is going to fall 25 to 30%, in my opinion, minimum. And that's going to have a major impact. Well, the biggest headache now with the central banks is trying to work out how they're not going to create a property crisis. Now, the stock market in the US has gone up from beginning of January to now based on the outlook on inflation, the outlook on interest rates. That was all scuppered when Jerome Powell gave the testimony to Congress on Wednesday, stating that rates will have to rise probably another 50 basis points in 2023. In my opinion, they're going to rise another 50 to 75 basis points in 2024. So I think we're looking more at the level of 6% plus interest rates, not 5% plus interest rates. So I did say this already back in January, February 22, that rates were going to rise to 4.5% in 2022, which, as it happens, was absolutely 100% right. And now rates are going to rise even further in 2023 and 2024. This is causing instability in financial markets. Markets will fall as a result of this instability. They've gone up not because fundamentals were great, because the outlook looked stable. Financial markets like stability, whether it's stability at a high expense rate or stability at a low expense rate, they like stability. And what actually happened is that from January, it looked like the outlook was stable. It's not stable enough to push this market up. Fundamentally, this market is well overpriced and it needs to come down and correct. We're not talking about a 3% correction. We're not talking about a 5% correction. We're talking about at least 10, 15% correction short term. Medium term, we're talking more like a 25, 30% correction on equities, on stock market. That's in addition to property. Property lags the stock market by around about 18 months. So keep an eye on that. Tesla, as an example, is overpriced. People are calling it now 300, 350, overpriced. Needs to come off. The real level of Tesla today is about 180 to 200. It's well overpriced, far too high. It also applies to the tech sector, but because they're being pushed by all of this excitement on AI frenzy, which is well over the top, FOMO, which is also pushing prices higher, they need to simmer down, and those prices need to drop in the tech sector by at least 10%, minimum, more like 20%, to bring it to any sort of reasonable value. So the equity markets are overvalued. There was a bit of dollar strength yesterday on the back of rising interest rates in the US. So the pound, the euro came off. The dollar yen's interesting, looking at 141, 142. I've said all the way through from 130, it looks like a buy. Bitcoin touched 30, went above 30. It's come back down below 30. Anyone's guess. Bitcoin's very volatile. I think it'll probably move up from here, in my opinion. If it can just hold on to 30, looks like the next level is going to be $35,000 to $40,000 a coin. So that's looking good. Could be wrong, of course. Gold has come off. The interest rate environment looks very, very nervous. And overall, I think we're in for a major property crash. Correction. And a major stock market crash. Correction. You can also follow me on TikTok and also on Instagram. I've just published a book on Amazon. We get another one published now, or writing one on trading. Subscribe, share, comment. Speak to you soon.